Today, we'll be covering a topic under business studies by discussing the various forms of ownership.
Subscribe now
To Kano Academy. So, let's get started. As an introduction, forms of ownership refers to the type of business a business owner wants to register and start. Various factors need to be considered before deciding on the form of ownership, as they may have an impact on the success or failure of a business. There are various forms of ownership. In this video, we will discuss the following 6 forms of ownership, which are sole proprietorship, partnership, closed corporations, private company, public company, and state-owned company. Now, let's discuss each of these forms of ownership in more detail. Let's start with sole proprietorship. Some of the characteristics of sole proprietorship are as follows. A sole proprietorship, otherwise known as a sole trader, is a business that is run and owned by one person. This is the simplest form of business ownership, in which a single individual owns and operates the business. The owner of business has unlimited liability for the debts and obligations of the business. The owner is also responsible for all the financial and management decisions of the business. Some of the advantages of a sole proprietorship are as follows. It is easy to control, since it is a small business. There is only one owner, therefore, there is no disagreements in the decision-making and management. The business tends to make quick decisions without having to consult others. Some of the disadvantages of a sole proprietorship are as follows. The owner has unlimited liability and is legally responsible for all debts of the business. Capital is limited to the creditworthiness of the owner. This limited capital could limit the possibility for growth and expansion. There is also lack of business continuity. The business is not always possible to pay high salaries. The owner could concentrate on strong points and neglects other functions. The next form of ownership we'll discuss is a partnership. Some of the characteristics of a partnership are as follows. A partnership is a type of business that is run and owned by 2 to 20 individuals, called partners. These partners agree to share the profits and losses of the business. Partnerships are normally governed by a partnership agreement that outlines the rights, responsibilities, and profit-sharing arrangements. Some of the advantages of a partnership are as follows. Partners are actively involved in the business and may use and rely on the ideas of other partners. However, not all partners need to be actively involved in management and would rather appoint competent managers. A partnership is easy to establish. It is also easier to raise funds. Partners are motivated to work hard because they share in the profits of the business. Prospective employees may be attracted to the business if given the incentive to become a partner. Partners share responsibilities and management of the business. Partnerships are not forced by law to prepare audited financial statements. Some of the disadvantages of a partnership are as follows. Partners are jointly and individually liable for the actions of other partners. In general, all partners share equal responsibility for the business's debts and liabilities. Partners have unlimited liability for the business's debts. Decision-making process can be complicated. The next form of ownership we'll discuss is a close corporation. Some of the characteristics of a close corporation are as follows. A close corporation is a legal entity that combines features of both a partnership and a private company. It is owned and managed by a small group of individuals, usually between 1 and 10, who are known as members. It offers limited liability to its members, meaning their personal assets are protected from the business's debts and liabilities. Closed corporations have fewer legal requirements and are less complex to set up as compared to companies. Some of the advantages of a close corporations are as follows. There are fewer legal and accounting requirements for close corporations. A close corporation is a legal entity and therefore, has continuity. A close corporation can also be converted to a private company. Even more capital can be raised under a close corporation. Members of a close corporation have limited liability. Owners' interest in the close corporation does not need to be in proportion to their capital contribution. Close corporations may be exempted by the CIPC from auditing its financial statements. Some of the disadvantages of a close corporations are as follows. A close corporation cannot have more than 10 members. A member of a close corporation can be held personally liable for the losses of a close corporation if the member acts carelessly or is incompetent. When applying for a loan, audited financial documents must be presented. Funds will not be given until an audit is completed. A close corporation is taxed as if it were a company, which may be higher than an individual's personal tax rate. It is often difficult for members to leave the close corporation or to pay a member their portion, as all members must agree to dispose of a member's interest. Like a company, a close corporation is taxed on its net income. The next form of ownership we'll discuss is a private company. Some of the characteristics of a private company are as follows. A private company is a separate legal entity, owned by shareholders. It requires a minimum of 1 shareholder and a maximum of 50 shareholders. The liability of shareholders is limited to the amount they have invested in the company. Private companies must have a memorandum of incorporation that sets out the rules and regulations for the company. Private companies are also subject to more legal requirements and regulations than close corporations. Some of the advantages of a private company are as follows. There is unlimited number of shareholders, to a maximum of 50. The company usually has business continuity. Shareholders have limited liability, which means that their personal liability for the debts and obligations of a company is limited to the amount they have invested or committed to the company. This form of ownership is suitable for most types of businesses, whether small or large. A private company is also a legal person, and therefore has the ability to own assets, enter into contracts, and be held liable for its actions. The new Act also forces personal liability on directors who knowingly participate in carrying out business in a reckless or fraudulent manner. A private company is not required to file its annual financial statements with the Commission. Financial statements are private and not available to the general public. Board of directors with expertise and experience can be appointed to take decisions and delegate responsibility. Some of the disadvantages of a private company are as follows. Private companies are subject to many legal requirements. It is also difficult and expensive to establish, as compared to a close corporation and a sole proprietorship. The Memorandum of Incorporation must forbid a private company to transfer its shares to any member of the public, because the company is not listed on the JSE. A private company's annual financial statements may be reviewed by a qualified person, which is an extra expense to the company. A private company also pays tax on the profits of the business. A private company must further prepare annual financial statements. The next form of ownership we'll discuss is a public company. Some of the characteristics of a public company are as follows. A public company is a separate legal entity with limited liability. It can have an unlimited number of shareholders and can raise capital by offering shares to the public. Public companies are subject to more stringent regulations and reporting requirements compared to private companies. Some of the advantages of a public company are as follows. A public company has continuity of existence. A public company is a separate legal person, meaning it is recognized by the law as having certain rights and obligations, and has the ability to own assets, enter into contracts, and be held liable for its actions. A public company can be owned and managed by only 1 shareholder and 3 directors. Shareholders in a public company have limited liability. Additional capital can also be raised by issuing more shares, or debentures. Shareholders can sell and transfer their shares freely. The public have access to the company's information, and this could motivate them to buy shares from the company. Some of the disadvantages of a public company are as follows. Shareholders may be allowed little or no input into the affairs of the company. Due to legislation, decisions take longer, and there may be disagreements. There are huge expenses when setting up a company. For example, legal, accountants, taxes, consultants, etc. There are also more people to share profits with, therefore less income. Financial affairs must be made available publicly. This information could be used to competitors' advantage. The last form of ownership we'll discuss is a state-owned company, also known as a state-owned enterprise. Some of the characteristics of a state-owned enterprise are as follows. A state-owned enterprise is a business entity that is fully or partially owned by the government. It operates in the public sector and is established to provide essential services or to undertake specific commercial activities on behalf of the government. The government appoints the board of directors and exercises a significant level of control over the enterprise. Examples of state-owned enterprises in South Africa include Eskom and Transnet. Some of the advantages of a state-owned enterprise are as follows. State-owned companies often have easier access to capital than private businesses, as they can borrow money from the government or government-owned banks. State-owned companies are less likely to be affected by political changes than private businesses. State-owned companies can be used to promote social goals, such as providing employment or essential services to low-income communities. State-owned companies can also be used to protect national security or strategic industries. They can also play a role in economic development by investing in infrastructure, education, and other sectors that are important for long-term growth. They can also help to promote competition and innovation in the private sector. State-owned companies can also be a source of employment, especially in developing countries. Some of the disadvantages of a state-owned enterprise are as follows. State-owned companies may result in poor management due to political interference. This can lead to corruption and inefficiency. There is also a lack of incentive for employees to perform if there is no share in the profit. State-owned companies often operate in sectors where they have a monopoly or are dominant in the market. This can lead to lack of competition and complacency. Let's recap on what we covered in this video. We learned about the various forms of ownership, which are sole proprietorship, partnership, close corporations, private company, public company, and state-owned company. There are advantages and disadvantages for each form of ownership. So, the best business ownership structure will depend on a number of factors, such as formation procedures and costs involved, continuity and dependence of the business on its founders, legal liability and personality, taxation cost appetite, management and control, and capital requirements.
We've come to the end of this video. Remember that you can always re-watch the video if you need more understanding on the topic. We hope we were able to provide more clarity on the topic. If we have, please leave us a comment below this video, because we'd love to hear from you and what you have learned from this video. You can also like this video to show your appreciation, and you can also share it on your social media or via WhatsApp. Until we meet again, happy learning. From all of us at Kano Academy.